Hi, my name's Joshua Mahony, Chief Market Analyst at Scope Markets. This week crescendos into Friday's Core PCE metric release for the US economy, and certainly that inflation gauge is going to be absolutely key as we look for guidance on exactly when and by how much the Federal Reserve will cut rates this year. It keeps getting pushed back. It was 7, then it's 3, now it's 2. Could it even not happen this year? Well, certainly this inflation metric, which is the favored one for the Federal Reserve, will give us a greater idea of the direction of travel for prices in the US. We have just seen the latest core durable goods number coming out strong. So another warning sign that the US economy remains in a very healthy position, but that doesn't necessarily facilitate a big drive down towards target in terms of inflation. Let's get into it. First and foremost, these are expectations for the release in terms of trading economics. We can see that the month-on-month figure is expected to come in at 0.3%. Same monthly figure expected for the headline number. The core PCE year-on-year number is expected to decline to 2.7 from 2.8. But the headline number is expected to rise to 2.6. So the key thing here is that we've got the potential for a continuation in that downtrend, 2.8 to 2.7 on that core PCE metric. But really, you've also got to look at that monthly figure. If we stay around the 0.2, 0.3s, then we're sort of just above or heading towards target. But if we get anything above that 0.3 number, then that really could provide a warning sign to markets that the US inflation and US sort of price situation in the country is continuing to run hot, and that we're not necessarily going to get back down to target. In terms of expectations as things stand for the Federal Reserve, you can see that the expectation is that the first rate cut comes in September now. That was previously June, then July, now September. Will we see that push back further? Well, certainly if we see an upside move in terms of the core PCE metric, that would likely feed into this idea that maybe we don't even see it happen in September. Next, let's look at the shift that we've seen of late, and that has really informed market sentiment. And we can see first and foremost that June meeting was previously priced in as the base case scenario. As you can see here, that a month ago, we saw an over 60% expectation that we would see that first rate cut coming in June. Well, it's now below 20%. So really, the idea of a June rate cut has been essentially eradicated. Now market is very confident that we will not see that, over 80%, and it has been increasing over recent days. In terms of the December meeting, so essentially how things going to look by year end, markets still believe that zero rate cuts are sort of out of the question at the moment, around about sort of 10 to 15% expectations. Instead, sort of torn between the idea that we're going to see 125 basis points cut or a total of 50 basis points downside in terms of rates. And so really it's this shift in expectations that we see over the course of this year that's likely to inform sentiment when it comes to the US dollar, also when it comes to US equity markets. And we have been seeing that of late, that continued pushback in those expectations do drive equity markets lower, have been driving equity markets lower. That doesn't always happen, because earlier in the year we also saw that happening, and we didn't necessarily see a huge reaction because it came alongside the Q4 earnings season, which was relatively strong. So markets really concentrated on that instead. At the moment, there have been some significant question marks about this earnings season for Q1, but at the same time, we're seeing them push back those expectations in terms of what the Federal Reserve is going to do. Let's get into the nuts and bolts of the data. So this is the chart that I often utilize, where we're essentially showing you the trajectory of core PCE against core CPI. Also looking at the month-on-month readings that you can see in the middle section here, and then looking at an annualized figure. On this occasion, we're looking at the 8-month annualized figure. So where would we be in 4 months' time if we stay on the trajectory that we have seen over the last 8 months? First and foremost, you can see here that core PCE is the best served metric to get back down to target. If the Federal Reserve's looking for a reason to cut interest rates, the core PCE number is likely to be where they're going to look, not core CPI, as you can see, well above where the PCE number is. And look, ultimately, this is their favorite metric. So that makes sense. And it does provide that sort of chink, that little bit of light for bulls to think that we could see them cut rates in the not too distant future. In terms of the middle section, you can see that the breakdown in terms of month-on-month inflation shows that January really set us back. January and to some extent February set us back in terms of that 0.4 gain that we saw last month, and the chunky figure that we saw back in January. That really needed to sort of come in line with the averages that we've been seeing through July, August, October, November, December, all nice figures, generally around 2% or below 2%. Of course, that would take us back down towards target. So we need to get more towards the 2% mark, and certainly figures like 0.4 or 0.5 do the complete opposite and instead set back the whole outlook for the year ahead, as we don't want to have to wait until next year in February for that big January figure to be stripped out, which is the case because that's the biggest reading that we have seen on a monthly basis over the time span that we're looking at here, which is roughly a year and a half. So that is a problem. And instead, when you have big numbers like that, big 0.5 readings, 0.4 readings, it means that you need to see something in the future that instead of 0.2 comes in more like 0% on a month, which doesn't look like it's a possibility. So it really does set back expectations for a move back down to target. As we can see here, the annualized figure points towards us getting back towards that sort of 2.5 number in, say, 4 months' time. Now, that isn't necessarily great because what we're looking at the moment is a move from 2.8 to 2.7. So we're talking about over the next 4 months, a possibility that we maybe move, from 2.7 to 2.5. It's not necessarily a straight shot back down to 2%. It's likely to be a very protracted move. And what we can see, if we're sort of casting our mind back to what's happened in those monthly metrics here in the middle, we're stripping out this 0.336. So there is a chance of that disinflation if we see 0.3, which is expected, or something below that. And then the next 2 months, you can see that's where we can see some further disinflation, as both the April and May numbers look relatively healthy, which are those sort of orange bars in the middle that I'm looking at here. But then once we get into June, July, August, you're talking about 3 months where there's a good chance that we either flatline in terms of the core PC, or we start to rise, because it's difficult for us to really get below the numbers that we've seen on the month-on-month basis in 2023. So the disinflation that we're likely to see this month and the next 2 months likely to essentially be it for some time from there onwards. And therefore, this idea that we're going to see, as markets are pricing, a September rate cut. Well, if you look at September, that's when the next significant figure comes out, but generally that'll be released in October anyway. So there's a good chance that by the time we come round to September, where people are thinking that we're going to see a rate cut, instead we're likely to see core PCE somewhere around about 2.5%. So it's going to be a struggle, quite frankly. And I think there's a good chance that we don't see a rate cut this year at all. It really comes down to the Federal Reserve's willingness to act irrespective of the data. Like, do they need to actually hit 2%? Because they're not on a trajectory to hit 2% as things stand. And certainly the big prints that we've seen over the past 2 months do highlight a higher possibility that we see sort of increases in terms of this PCE rather than declines. So, if we're talking about a potential move back down to 2.5% in the coming few months, well, I think beyond that, I think there's a good chance that we move upwards and we find ourselves back to 2.8% by the time we're expected to cut interest rates. So for me, I think there's a good chance we see the expectations of those rate cuts pushed further into the future. And you can see exactly why as we draw down into the metric here. So this is an overview of both core PCE and the headline PCE numbers, both on a downward trajectory. But like I said, it looks like the next few months could see a continued tick lower in terms of certainly that core PCE number. But then it's a case of probably flatlining and maybe rising after that. So if we chart it here against the US 10-year, now you can see it hasn't necessarily rolled over, because recently we've seen a move towards the upside as you see those inflation metrics coming out towards the upside, and stronger inflation does point towards the possibility of further upside in terms of the 10-year. For the time being, we have, like I said, over the next few months, got the possibility that we do see some downside in terms of this core PCE metric that could temper the 10-year yield somewhat. But certainly, if we're looking at this core PCE release, if we're looking at a bigger number, if we see an increase in that number, you'd expect to see the 10-year yield move towards the upside once again. And as we can see here, if you chart the 10-year yield against the dollar index, further upside for the 10-year would point towards further upside for the US dollar as we see a risk off play coming into the mix. Let's grab some of the charts and show you exactly how some of this is playing out. So first and foremost, we're talking about the possibility of, okay, let's say if we see a strong PCE number, then that really would dent the hopes even further. Because like I said, I think the disinflation is only going to happen on this report alongside the next two reports. So if we see a stronger than expected number and we don't see the decline in that year-on-year figure, then that sets things back even further. So that would likely drive dollar strength, higher upside, into a big upside in terms of the 10-year yield, upside in terms of the dollar index and the US dollar as a whole. That would likely drive downside for the likes of euro dollar, which I've got charted here, which is the candles essentially. And then I've got the S&P 500, which, I mean, I can show you different parts of it, but it sometimes plays out with a strong relationship, sometimes doesn't. I've zoomed it in because this is sort of a period where it has played out relatively well in terms of the positive correlation between euro dollar and the S&P 500. But as we've seen over the course of 2024 thus far, the S&P 500 did relatively well over the first few months. It's only just now that the sort of pullback that we're seeing, so the strength of the US dollar and those concerns are actually feeding into the S&P 500 with some weakness. So if we see a strong PCE number, I think there's a good chance we're not going to see a rate cut coming into play this year. Quite frankly, we'd need to see some significant disinflation coming into the form. We're not seeing it at the moment. So those expectations will likely get pushed further out. The US 10-year yield will likely rise. The US dollar would likely rise, and then we'd see weakness in terms of euro dollar and likely weakness in terms of stocks. But of course, if we do see a greater than expected decline in terms of, or if we see a decline because we're expecting to see 0.3 replicated on that core PCE monthly metric, then you're looking for a greater decline in that year-on-year figure, and maybe people start to think, great, okay, we're heading back towards target. As we've seen, we're not heading back towards target, but nonetheless, you know, short-term reprieve could be provided, which would likely see the likes of euro dollar gaining as we see dollar weakness, and the likes of the S&P 500 gaining as a result. This is the S&P 500. You can see we've come in for a significant decline of late, moving back down from the likes of, as we can see, the peak around here is sort of 5260s and down towards sort of 5,000 mark. Well, we're regaining ground now. The question mark is whether that is over. Part of it is going to come from expectations in terms of monetary policy. But I would say probably more importantly, we're going to see a big impact playing out by sort of tech stocks and expectations for earnings seasons and earnings as they come out. I mean, of course, we've seen strong rebound in terms of Tesla shares. And so if we see some strength in terms of the semiconductors, in terms of AI revenues, then that should help things recover further. But as we see on the 4-hour chart, things don't necessarily look like they're fully resolved as things stand. You can see on the bottom end, you know, we've got this trend that very clearly came to an end. And then from there on in, we're sort of seeing these declines. We've seen this nice move up through this near-term swing high, tentatively so, which is 50.79 or 50.80. That could point towards further upside, but I am aware of this sort of wider potential retracement that could come into play. And so you're looking at 5113, 5151, which are the deeper Fibonacci zones, the 61.8 and the 76.4 Fib. I think there's a good chance that we rally in towards Friday and we potentially weaken around this core PCE number. Of course, it depends on how it comes out. And I've outlined two different scenarios depending on if it comes higher or lower. But I think if you're looking at this sort of very steep pullback that we're seeing, you know, this rally that we're seeing at the moment does hold the possibility of essentially sort of coming into the wider decline there. So we could see a possible essentially you're seeing this, right? Down, but then back to that median trajectory and then down again. I think that's a strong possibility, quite frankly. I mean, look, it does come down to exactly how things play out in terms of core PCE, but I think it should influence things quite heavily. But as I said, when it comes to the stock markets, it isn't always a case of just reflecting monetary policy, and that's why a lot of the time when you're charting, say, the S&P 500 against, say, the US 10-year, is going to be a less convincing relationship compared to the FX markets, say the US dollar against the 10-year. So let's just go on to the US dollar and we can see exactly how things are playing out. This is a sort of overview of some of the markets. In terms of those currency pairs that are seeing strength, you're seeing dollar yen, of course, continuing to play out towards the upside. We have seen some of the gains, the rebound in Aussie dollar sort of tempered somewhat. But that's another play because we have seen Australian inflation coming out strong. So now markets are equally, actually markets are pointing towards a higher likeliness of a rate hike than a rate cut this year, but generally just looking for them to keep rates steady over the course of this year. Let's look finally in terms of back to euro dollar, and actually let's go back. Let's go on to say dollar yen for this. It's going to be an interesting one as well. I have provided a preview earlier in the week as well for the Bank of Japan interest rate decision. This is really going to be an interesting market to watch as we see this breakout coming into play once again. If we see strong core PCE numbers coming out, then there's a good chance that we do see this breakout coming into the fore once again. This is a chart that's worthwhile being cautious of because of the fact that we've seen plenty of talk around intervention from the Bank of Japan, and they are coming into play once again. So keep an eye out for that. Again, let me just bring up the Aussie dollar and highlight one that could potentially show the possibility of a move towards the upside if we see weakness in terms of that core PCE number, just because of the fact that we're now really digesting that news in terms of the Australian inflation number. If we see a weak core PCE number, then there's a possibility that what we're seeing at the moment is a sort of bottoming out here within a pattern that has certainly been convincing on the top end in terms of declines. So you can see on the top end, we're continuing on this downward trajectory, but on the bottom end, we're seeing this ascending low. So as things stand, we've pulled into the 76.4 fib. We've found support. We're regaining ground. If the PCE number comes in weak, I'd be looking towards this Aussie dollar pair to potentially push towards the upside as we see some of the money flow out of the US dollar, and we see potentially people feeling positive about things over the time being for in any case, just because of the fact that, like I highlighted, I think there's a good chance that we don't necessarily see a move back down to target, even if we see a lower than expected core PCE number. So for the time being, we could see further upside coming into play, and then possibly just continuing to play out with this symmetrical triangle move and a move back up towards that descending trend line on the top end of this. But certainly this is going to be a absolutely key release for traders to be keeping an eye out for. It does look likely that we are going to see US inflation remain a problem over the course of this year, quite frankly. Markets continue to push back expectations for that first rate cut. And for me, I think that even if we do see a downside move for core PCE, which is not expected in terms of the monthly metric, it is for the annual metric, I wouldn't get too comfortable with it unless we see the Federal Reserve come out and say that they're willing to cut interest rates even before they see inflation hit target, because they're not on a trajectory to hit target anytime soon. And that does raise the possibility of further downside in terms of equity markets, further upside in terms of the US dollar, as markets gradually over the coming months realize that that move back down to target doesn't look likely before we see that September meeting, which is when markets are currently pricing that first rate cut from the Federal Reserve. So might be a little bit optimistic as things stand, but that's something that I've been saying for much of this year, and we keep seeing those expectations for a rate cut pushed further and further and further into 2024.